Hi, this is Andy Filipiuk in Toronto for the week of December the 4th. The past week has been totally chaotic. As a week ago, the Fed Chairman Powell made a speech indicating that the Fed was closer to stopping on the interest rate hikes than previously believed. As a result, the stock markets roared and then they reversed. So right now we're in the midst of a downturn as I do this video. Now, more importantly is the yield curve. In the US, the 2 to 10 year yield curve has plunged from roughly 30 basis points a couple weeks ago to just 10. Now, what an inverted yield curve means when short-term rates are higher than long is the bond market's way of saying that credit is too tight and a recession is likely to follow. So looking at this situation going forward, the markets are now telling you that a recession is on the horizon. So it's pretty wise to pay attention to that. A couple weeks ago, I showed charts from Brent Johnson's speech at Santiago Capital showing the amazing amount of emerging market debt that matures over the next several years that has to be paid back at higher interest rates and in US dollars. Last week, I saw a great video of Danielle DiMartino Booth. She's a former employee at the Dallas Fed, where her problem now is the amount of high yield or subprime corporate debt in America. And she shows a chart. I've included the Brent Johnson chart and the US high yield corporate debt chart that shows just how much corporate debt matures over the next several years. In fact, these charts remind me of 10 years ago in the housing market when the subprime and the Alt-A mortgages had a massive amount of maturities and they were going to be done at much, much higher rates. So we've got the same problem here of just a massive amount of debt having to be refinanced at higher yields. Now, unfortunately, a lot of corporations have borrowed when interest rates were low and spent a lot of it on corporate buybacks, etc. So now corporations could be squeezed as they're forced to borrow more capital in a tougher market at higher rates. As of the end of November, the permanent portfolio is now down 1.5% year to date. As I've mentioned in the past, we are only 20% in the equity market. And given what we're seeing on the horizon, I'm very confident that the permanent portfolio will be able to withstand this and also profit from changing conditions. The 10 years of quantitative easing look like they're at an end, and policymakers are going to have to look in other directions going forward. It's a very, very dangerous time. Thanks for watching.